Welcome to this video. I'm going to show you guys a high probability trade, and let's go into it right now. And the rule number one by Warren Buffett, as many of you guys would have already known, is to never lose money. But I want to ask you the question, very important. Does the casino win or lose money? You can see in the picture right here on my slides, there's a guy celebrating. Very likely he has won some money. The casino probably lost money to that gentleman. But for the whole entire evening, they will still win money. I want to go back to these fundamentals is because I need all of us to think like the casino. We should not think like the individual gambler. Individual customers may win money, but overall the casino wins. How do they do that? Looking at the screen, right, which is the one that gives you the highest probability? If I place a bet on red or black on a roulette, what is the probability of me winning? 50-50. You guys are excellent. You know simple mathematics. At the same time, your eyesight is not very good. Do you know why? Because if you bet on red, can you see there is the probability of landing on red, black, or green? The casino just need a slight advantage. The probability of you winning any of this, the highest chance is 46% if you place even and odd. Now, how does this matter? It matters because the casino only enter trades that has a higher probability. The first important aspect of not losing money is to only enter high probability trades, trades that are in your favor. The second portion is very important as well. Now, imagine Elon Musk comes along, plays the roulette, and he says, I want to bet my whole entire net worth on even. As a casino, will you take this bet? Even though you have a higher probability of winning, Elon Musk still has a 64% chance. So there's a maybe out of 10 times that you play with Elon Musk, there's a 4 times you can win. It's still quite a high probability, right? So you must understand that probability is not enough. There must be table limit. Limit in the investment world is translated to position size or diversification. Because even though the probability is in our favor, it is never ever 100%. There will still be a chance that we may lose. When I talk about high probability, I'm going to go into 4 key aspects. Today, I'll be going into one of them. The first thing is I buy companies with good fundamentals. I believe that they will be continuing in the long run. Second thing, buy at cheap and fair valuation. Third thing, buy at good technical analysis. Every single check, good company, good valuation, good TA, my probability of winning increases, but it's never ever 100%. Have you ever seen a very high probability trade? You feel so excited, you over trade or over invest, and you regretted? Any of your experienced that before? Now, let me share with you. The last thing I want to talk about is volatility. For those who are not familiar with options, can you please let me know as well in the comments so I know how much to share in terms of options? Options allow us to go very low risk and get very high returns. I will cover a bit of the fundamentals in this video. So if you're very new, don't worry, I'll be sharing with them a little bit more into details. So this is very exciting. Now, today let's talk about volatility. And let me share with you, for options volatility, just to check and make sure that those who are with me for some time, at least you all know what I'm talking about. Now, volatility, this is the VIX index, the volatility S&P 500 index. Volatility or implied volatility, it means 2 things. Implied means suggested. Okay, you all heard before this thing called implied volatility, IV. Implied means suggested. So example, I say, wow, your shirt looks a little bit tight today. Then my friend say, are you implying that I'm fat? Okay, so he's taking my words and then translating it into some possible meaning. So implied volatility, the word implied means that it is suggested. Volatility means fluctuation. If let's say it is very stable, it is low volatility, no one is investing in the stock market, volatility will be 0. When it's very high volatility will be 100. So for the S&P 500 index, volatility index, can you all see here? It's called VIX. Can you all please help me type down the ticker symbol VIX, because this will be very useful to you. Right now, you can see there's a volatility. Okay, they actually give us a particular number to it. Let me go into history. Can you see it spikes up as high as, let me make the graph a bit smaller. It goes as high as 80 something. There's unlikely volatility will be like more than 100. If it be more than 100, it will normalize and then there will be a new 100. So based on the historical data, it will be from 100 to 0. Does it make sense? Okay. So now the low of the volatility right now, it is about 13. At no point in time is possible for volatility to go to zero unless there's a shutdown of the market for the next few years. If they shut down market for the next 3 to 5 trading days, right? Example, during Lehman Brothers, during global financial crisis, when the market is shut, okay, people are not allowed to trade. Make a guess, is volatility high or is it low? During the periods when market is shut down, is it high or is it low? It's super high because everyone is suggesting that once the market is open, the fluctuation will go crazy. People will not buy a bit here and there. When the market open, some of the shares they are going to dump. Some of the shares they're going to go in and grab. You get what I'm trying to say? So volatility is an implied of what the stock market may move in the next few days. Now, right now, can you all tell me, is the volatility high or low? Right now, this is today, is 13.3. Is it considered high or low? It's super low. Now, what is the reason for that? Okay, it's extremely low, right? Now, for those who have been investing for a while, when volatility is low, what happens to option prices? Is it cheap or is it expensive? So this is something that really helps you make better decisions, because if you know something is cheap or expensive, you will know whether to buy or to sell. Okay, so cheap, right? I was very excited because you can see that volatility has went up, it has come down. Now, why am I so excited? And why is volatility so low? Let me explain a few things. Let me give you a few, I would say, useful resources. And later I'll put them into the Telegram group so you all can go and click on it as well. So let me give you some of the resources first. Okay, hang on a minute. This is the first resource, the trading view chart of VIX. Now, the second resource is something that I find quite useful. It's called Forex Factory Calendar. It will tell you what are the big news that's coming out that may affect the volatility in the market in terms of the Forex, okay? Meaning you say, like, example, USD versus Japan and things like that. Now, you can see this week, 8th of May, there is really nothing much for US already, okay? Nothing really isn't a lot. So you can see those that affect US will be in USD, and those that affect US very greatly will be in red color. So red color, US, Friday, there will be 130-year bond auction, and then nothing much, okay? See, it's pretty quiet. Therefore, volatility is on the low side and market is slowly climbing up. When the market crashes, goes down, volatility will spike again. But typically, when there's big news coming out, volatility will increase. Okay, Ken? Thursday unemployment. Okay, let's see what happens. Will volatility spike just before unemployment or after unemployment announces? So we will see in a moment's time. So guys, is this useful so far? If it's useful and you want more sharing like this, please let me know in the comment also. Now, the thing is this. Today, I want to share with you a very interesting possible idea, which I myself will be leading the super investors to do, is this thing. We can actually trade volatility. So this is the VIX index, right? And VIX index can be traded using options. You cannot buy the shares. There's no VIX shares, but there's VIX options. Okay, so I will be sharing with you. If VIX, right, think about it. If VIX is so low right now, and the volatility is low, meaning you say the options is cheap, plus, in my opinion, I believe based on historical data, the chance of volatility going down to zero is zero. That's my own opinion. What do you guys think? Do you believe that volatility will not go down to zero? Okay, because if you believe that volatility will not go down to zero, and given time, it will spike up, right? This may be a good chance to go in and buy the shares, if it's possible, buy the shares of volatility. But volatility doesn't have shares. What we can do instead is we can buy a long-term call option. Okay? So that's why I say it's a very high probability trade. Am I using too much words? Probability, volatility. It's like a tongue twister today. But I hope you guys are catching up with me, and I will edit the video a little bit and I'll post it onto YouTube, then you can go and watch it again. Okay. So you can see that it is at a historical low. It's around this range. It may drop a little bit further, but I do not believe that for the next 1 year, it will remain low. There will be things that happen. And you can see that throughout history, it always spikes up, come down, spikes up, come down. It is so predictable. Unless, can you help me think of something? What possible thing may happen that causes people to have zero interest in the stock market anymore? I can't think of any, okay? So if there is a zombie breakout, maybe volatility very high, people will start to buy Lockheed Martin shares to actually buy the weapon and kill zombies. I don't know. And a new company will come out with a zombie disinfectant, right? China giant rush. You're quite funny. Okay, COVID. In fact, COVID at time the volatility goes crazy. So you can go back in time to zero. This is COVID period. If it's COVID, or if we buy the volatility index now, if there's another COVID, we will make tons of money. Okay. Okay. Now, anyway, coming back to here, I want to share with you another very good resource that we have here. Is called Option Strategy. Let me put it into the chat as well. Okay, I will share. Yes, I will actually do that. Bob, next time I don't feel well or anything, please take over my, I would say, Zoom session, because you know I'm going to do already. Like the worm in my stomach. Okay, excellent. But let me share with you something I found today, which I almost go crazy. Now, for those who are very new to option strategy, you can actually use this particular website. You can go and build different types of option strategy. Let me share with you guys how to interpret all these strategies first so that it'll be useful for you. So for option strategy, when you click on build, when you mouse over, oops, let me push the zoom aside first. Give me a moment. Okay, when you mouse over the strategy, can you see that this particular picture over here? This is called the risk graph. Okay, later I'll explain to you the risk graph. But what I would like to see is whether the stock, okay, because in this case, in this particular case, for VIX, we believe that it will go up, right? We want to see a risk graph that will make a lot of money on the right side. Okay, so let me explain this. Okay, now, let me show you, this is a risk graph. This is an unrealistic risk graph, but I'll explain to you guys in a moment's time. Okay, example. Just now we mentioned buying a long-term call for VIX. So I'm going to go do an example right now. VIX positions, let me just remove them. Remove. Okay. Oh, okay. And then remove. What I'm going to do is I'm going to add and buy a call. Now, when I buy a call, I think it's the best way to explain this. For those who are not familiar with call, when you buy a call, you are putting a deposit to lock in the current price. So in this case, I'm putting a deposit. The price of VIX now is 13.32. I can buy a 13 call. Effectively, I'm locking in the price at 13. And in return, I have to pay $227. If you can look at the position here, if I click here, you can see I buy a VIX 13 call and the expiry date is 17th of July 2024. So I put a deposit, but deposit won't be forever. There will be a certain time if I do not go and collect the particular stock and pay the full payment, they will so-called forfeit my deposit. So this is the amount that I need to put as a deposit. I pay money to lock in to the price, 2.72. Now, why is this useful? Let me show you this. This is extremely useful because if, let's say, this particular VIX goes down to zero, really for some reason goes down to zero, okay, and I lock in the price at 13, there's no reason I will go and get the particular VIX, right? Okay, in this case, we don't really get a VIX, but let me just think of it like a normal stock. If the price goes to zero, will you go and buy the stock at $13? Answer is no. So what will we do? We will forfeit the deposit and say, I'm so sorry, you can take my deposit, and the maximum you lose is $272. As compared to if you buy the stocks. Okay, by the way, this $272, when we buy a long-term call, we are locking in 100 shares. Can you all please type 100 shares? Oh, you prefer to get credit? Okay, but later I will give you the credit. I credit you for coming onto this particular video to come and learn new things. So I acknowledge you for that. So you get some credits already. Okay, now anyway, jokes aside, for 100 shares, you need to pay 1,003. So your risk is 1,003 if it goes to zero. But again, let me share with you, the chance is extremely low. Extremely low. Right now, instead of risking 1,003, you risk maybe about 20%, around 20% of the amount, 275. Okay, you can go even longer term, okay, to 500. You can lock in. So instead of putting 1,003, you put in 500. Now, take a look at this, guys. Look at my mouse. This is the current share price of VIX. Okay, there's no shares, but think of it like a shares. It's 13.31. If the share price increase to 14, 15, 16, 17, 18, on the right side, as it increases, look at the tiny dot. Okay, this is my profit and loss. As it increases, I make more money. So you can see the amount that I can make is unlimited. Okay, in theory, it's unlimited, but maximum it can go up is to 100. Okay, so if let's say, really, as you guys mentioned, your crow mouth, your really say COVID come and lock down again, right? You may make for over $1,000 using a $500, I would say, deposit. Understand so far? Okay. So as the price increases, you make more money. Why is that? Because simply put, if let's say the price increased to $40, you have locked in the price at 13. You lock in the price at 13. So you can buy it at 13, you can sell it at 40. And the transaction can take place so fast that the money comes into your account immediately. You don't really need to go and buy the stock. Okay, you can just sell away the options. Okay, so this is for those who are into options. You can see that how we have been making money so far. Using the options, make money. We don't even touch the stocks. But so far, does it make sense? If it makes sense, still okay, still catching up, please tell me type yes. If you're totally confused, you may have to watch the video from the fund later when I load it up. Okay, can now, if the options drop, if the stock price drop from 13, drop to 10, drop to 5, drop to 0, maximum you lose is 535. Okay, this is talking about a long-term call. Long-term call all the way to January 2025. Let me ask you a very simple question. Do you guys believe that from now until January 2025, now it's May, right? May, okay, so there's what, about 8 months, 7 months? Within these 7 to 8 months, there will be a spike in volatility in one of the months, in one of the days. Do you guys believe in that? If you believe in that, this may be a possible good trade for you. You just buy it when it spikes up, just as it. Okay. So what we can do is we can be very conservative. We can say, okay, I'm putting in $500. When it spikes back up to here, so when volatility hits up to, let's say, even 20, okay, I'm going to exit. It's possible, or even 18. Now it's 13, go to 18, exit. You will make quite a good income. Very likely you'll make more than 100% based on my estimation. Okay. Actually, I don't need to estimate. I can just go here. Oops, where's my risk graph? Okay. I can just go here. If it goes up to, did I say 18? Okay. And let's say in a few months' time, goes up to 18, 20, right? You can make about a few $100 profit. Okay. So your 500 something, you will see that your options value now is 535. As the price goes up and the volatility increases, okay, that's the funny thing, when the volatility increases as well. So the value of it will be double because when it goes up, the volatility also increase, the value of the options also increase. Let's say it goes up to about 17, 18, right? You will make about 600 plus, 600 plus in profit. So take 600 plus the 500 plus, you are able to sell away your options at about 1,000, 1,002. Okay, this is how it works. So you are able to make about 100% because you put in 500, you can make 600 back. Okay, make 500 back. Okay, around there. So this one, the best way to do it, if you can afford, if it's okay with you, you can take a particular position into this. Again, I'm not supposed to make any recommendation, but this is what I will be doing. Okay, understand? Now, let me go back to something. Okay, I want to share with you guys, right? So do play around with this option strategy website. It is very interesting because this morning I was looking at this bull put spread for VIX and I almost fell off my chair. Reason being, let me just show this. This is something that was shocking to me. I missed the opportunity, but I'm going to wait for the next one and see whether it works. Okay, before that, let me go back to the long-term call. So the long-term call, you can see that they even tell you, for example, if you buy a long-term call, a 13 call, what do they think is the chance of you getting profit? What is the maximum loss? What is the maximum profit? Okay. So you can see this is based on their normal distribution. Okay. Again, they put here that it must be above 18 and things like that, and they feel that the chance is very low, 28%, right? It's based on normal distribution. But when we based on technicals and when we pull the whole entire adjustment of the time frame nearer, right, I can tell you visually, we can already see already. And the volatility is very low now. If it just increase by a bit, you can see that we can easily break even. This is the current price, 13.31. Even without anything happening, just by volatility increasing, by right, if the volatility increase, the price of VIX will also increase. You will start to make money. And the money that you make, remember, is in relation to how much you invest. So you can make 100, 200, and if it's only $500 that you invested, right, you're making 20% immediately. Got it so far? Okay, now, if not, again, play around with it. So you can see, I want to share with you, right? This morning, I was checking on this thing, on VIX, bull put spread. And this is today's bull put spread. So you can see, okay, it is very weird because I can see that there are certain trades, right? They put that the chance of profit is 100%. And when I check it, I think it was last night or this morning, I don't think that it has expired totally yet. Because okay, so I want to check the next one, 15th of May. I want to go back and see when I actually do a very low bull put spread because the price now is 13.31. I'm going to put at 13 or 12. I believe that probably they already calculated for the fact that it's going to expire in, let's say, a few hours time and things like that. Okay. So you can see that once the market open, it will expire in 2 hours time. But you can see it is 100% profitable trade and the maximum you lose is you don't lose any money. It's all credit. But there may be some glitch. I will go and test it out and I'll let you guys know. But it's a very rare, I see, 100% chance of winning. Something that's quite scary. But most importantly, I think very likely it's a glitch. So we can actually go and take a look at it. But there was this guy called Edward Top, which I was studying him. He actually did mention in his book, he found 100% probability winning rate in options before. So I'm trying to hunt for this again. So I've been looking for option screener. I've been like studying different types of options to see whether I can push up my percentage of winning to 100 or at least 99.9. But I think we have seen some of the very high probability trades like core ratio back spread, or we talk about this trade right now, the VIX. We do a very long-term VIX. The probability of losing, if we are willing to wait for long-term, right, is very low. Do you guys agree that? Do you guys agree that it's a very high probability trade? If you guys agree, you can type me. Okay. You understand? So for now, what we're going to do is, right, I'm going to do a long-term buy call. Okay, and why do I buy the call right now, right? Let me show you something. Going to bar chart, another, later, please go to the Telegram. I will put all the resources into this chat, okay? I won't put in the chat. I'll put in the main post. The chats one, sometimes there will be some imposters and scammers. So be careful of it. If they give you another link, don't go and click. I'll put all the resources into here. Then you can go and check on this. Okay, so I want to show you guys something. For the bar chart of CBOE, which is the volatility index, okay? Let's look at the IV percentile. The IV percentile right now for CBOE VIX is 5 percentile, which means that it's extremely cheap. Okay, so if we buy the options right now, we are buying it, locking it at a low price, and buying a cheap option to lock it at a low price. So it is double chance of winning. You know what I'm trying to say? So for those who are not very familiar with options yet, please pardon me. Please go and look at our past videos. Okay, so let me show you the history. The history is now is really super low. Implied volatility is 29.55, IV percentile is 5, and it has not been so low for a while already. Okay, there's 6, there's certain spikes of going down, okay, to certain points. So you can see that IV implied volatility can go up to 50, 70, 90. What we need to do is to turn around and then start to make money already. Okay, but we do not know. It may continue to go down further. Remember, this particular trade, let's put it into a long-term trade. Let's put it to a 8 months, 7 months trade. So within 8 months, if you can make 50%, 100%, do you think it's a good returns? If you think it's good returns, you can type Y. Y for yes. Okay, Ken? So this is the whole idea. So let me show you how I will execute the trade. How I execute the trade, right? Using IBKR. Oops. Later I show something very interesting also. Options pricing, right? You all know the options in the options market. Who determines the price? Anybody knows? Oh, sorry, I need my handphone. Give me a while. Yeah, I was asking. Do you know who determines the price in the options market? It's actually still buyers and sellers. So it's still based on demand and supply. There can be market makers, and CBOE, initially I always thought that the options pricing is based on CBOE's calculation, but it's always based on demand and supply. Okay? So meaning to say there are certain times the options, because there's so many different expiry date, so many different change, right? Sometimes it can be priced super undervalued. It's very interesting. Okay. Oops. Give me a while, guys. Okay. Let me show you this. You can see VIX 52-week implied volatility percentile 1%. 1%, it means that it is a super great Singapore sale or great mega sale, depending on where you are. Or Shopee 55 is over. Okay, probably they are giving us a big discount. Okay, yeah. Yeah, by the way, I want to emphasize again, by no means am I supposed to tell you what to buy or sell. This is really wanting to share my research and do your own due diligence. But if you don't mind, if you're my friend sitting at a coffee shop, you don't mind like testing out 300, 400, $500, it may be a very good way for you to start to understand options. Can? Got it, huh? Hang on. This one guarantee profit at expiration. Now, okay, the thing is for most of bear call spread. Okay, later we check. Wow, interesting. I like to check all this. But let me finish this portion first. Ooh, Hey, this is so interesting. Wow, Glenn has showed us another. Hey guys, can I? He has just shared a very solid stuff. Wow, this guaranteed 100% chance option. Excellent, guys. This is so excellent. Okay, we are looking at the IV percentile, not the IV. Okay, premium different than strike price. Premium higher than strike price different. Is it? Yeah, because there's a mismatch in premiums, right? Okay, let's see. 13 is 1.31 and then 10.5 is okay. This one call options correct, deep in the money. Okay, got it. Hey, so this is very good. Can y'all see what is he doing? He's sharing with you guys, right? Method to make money. Okay, can you all please help me thank him? Hey, he actually put this particular link there. Please go and click on it. So this is also a possible idea. I finished my idea first, but your idea is better than mine. Okay, frankly speaking. Okay, continue to go and search for all these ideas, then we can share with each other. But you go and do first. Okay, go and do first. Because sometimes after you do, the whole entire chain may end. We should go for IV percentile. IV percentile. Oh, the long-term one, the IV will change. But remember, when the IV percentile change, the long-term one, short-term one, everything will change together. Okay? Focus on the IV percentile. The whole entire chain will respond accordingly. Okay? Now, now let me share with you this. If you all can see, where am I? Okay, I'm at the longest 258 days. That's the furthest they can go. Okay, no problem. Why? Is because we think that from now until 200 over days later, within a few months, there will always be news when volatility spikes up. I think we can actually exit. So it's not for a long-term trade. This is a relatively short-term trade, but we go for long-term options because we don't want the options time decay to be too fast. Every single day, it is losing a bit of money. We want it to be as slow as possible. So let me show you an example. You can see we go for a 13 call. 13 call. You can see for 258 days, right? The 13 call, you can buy it around $5.30. This is the last price. 5.30. The 223 days one, you can buy it at, let me look for a while, 473. Okay, meaning you say from 258 days to 223 days, how many days is that? About 30 days. In 30 days, right, it lose about, how much is that? 50 cents of value? No, 60 cents of value. 60 cents of value. But 223 days and 195 days, you'll see. 478, 473. So which one do you want? 195 days or 123 days? I want to check your bargaining skills. Which one is a better deal? 195 days or 223 days? Obviously 223, right? 223 you pay 473. 195 you pay 478. This one cheaper, eh? Okay, but we must see whether can get or not. So, okay, the market is not open now, but essentially what I'll do is we will do a simulation. It will be roughly around that one. Maybe when market open, from now until then, I don't see any big news happening yet. So what we can do is we buy. We buy a long-term option. I'll click on buy and then 4.73, right? So I will just click order and then 4.73. Okay. 4.73 and then I will buy. Eh? Did I type wrongly? Or they don't let me do 473. Cannot be. Or 475 lah. Okay lah, buy. Okay, so I just put it in and then accept. Okay, so this has been submitted. Okay, so because use this order. Okay, the thing is because the market is not open yet. Is straddle a good idea? I think don't need to do straddle lah because the chance of it going down a lot is very low. Does it make sense? But no problem, go and test it. Now it's really very low for volatility. Unless it can go down really a lot. Otherwise, you buy the put, it doesn't give you a lot of profit. You know my thought process. Okay. But because the volatility is so cheap, you can test out the straddle if you want to. But you must be willing to, if it goes up, you lose money on the put. Okay, can? And okay, so after I buy the long-term call, the order is definitely not filled yet. Reason being the market is not open. But remember, I bought it at five. How much did I put? Oh, $4 and 475, right? Can you help me type 475 so that I can remember that? Help me type in the chat. 475. Everybody just help me type. So we bought at 475. Now, after I buy the long-term call for 200 days, what I can do is I can go to 6 days, 13 days, or 20 days and sell the short-term call, like what Bob also know that I'm going to do, right? Bob knows me well. So what we can do is this. Going back and look at the charts, you can see right here, we can target. Okay, we can target. Okay, maybe it can go up to, now it's 13 point something. It maybe can go up to 16. Maybe 16 is a possible idea, right? Okay. So we look at what they can offer us, within a few days, okay, within a few days, because this is a 6 days option, right? Let me spread this out a bit. 1, 2, 3, 4, 5, 6, about 6 days. Let's say it goes back to the 6 days high, about 16 or even 17. What I can do is after I buy a long-term call at 13, I can go and sell a short-term call. For 6 days, short-term call, even 16, I can get about $23. Okay? Around there. 26 to, now it's higher already. It's supposed to get higher. The bid-ask spread is 26 and 37. So probably minimally I can get 26. I can get 26, $28. Okay, can? So if I can get $26 in terms of premium, okay, how much is my ROI? Hey, you all realize that they don't expire on a Friday, right? They expire 6 days later, which is on another Tuesday. Okay, interesting. So now, if I can get 26, I just want to calculate the potential ROI. $26. This is what I will enter into my account, premium that I collect. And my initial capital is how much? 475, right? 475. So the ROI for 6 days, for 1 week, is 5%. How many of you think that is a good result for 5% in 6 days? And the risk is very low. Why is the risk very low? If the price goes down, okay, I just hold it, but I don't imagine it can go down to zero. From 13, maybe go down to 11, and that's all. Even if it goes down to 11, can I continue to sell call? Yes. Make another $10, $20. Maybe I don't get 5% a week. Let's say I can get 1 to 2% every single week. Is it considered good? That's 52% per year. So it's a pretty safe trade. So you can see, okay, I can go for 13 days if I want. Go and check through. Because you realize that they may misprice it. Okay, 16, this one. Okay, obviously you should go for the 6 days one, right? Because the 16 call for 13 days is 29 to 38. 6 days, 16 call is, it changes. Okay, it keeps changes. Okay, but I can take 23 as the benchmark. Okay, overall, this is the thing that I want to share with you guys for this evening. I hope I'm not going too fast because some of you guys just joined the video. You may need to rewatch the video from the start. Let me quickly edit and then I post it up. How many of you love this kind of sharing and you find that it's useful? If you do, please help me type number one. Number one means rule number one. So we can say all these things. Don't think that this trade is a confirmed guarantee 100% win. There isn't such things. For those who are very new, take a small amount, you can test it out. I shouldn't ask you to do that. If I'm very new, I will take a small amount, test it out, make some money, and then see what is the fluctuation, the upside, the downside. But in this one, this particular instrument, okay, the VIX, does it have good fundamentals? Good fundamentals, when we talk about a business, means that continuously there'll be demand. Will there be continuous demand in volatility? Will there be continuous demand in stock market? I think so. Therefore, I think that it has good fundamentals. Number two, technicals wise, is it on our side? I think it's on our side because it's an all-time low. It's very near the low. It's going to go up already. Okay, so I think technicals is on our side. There's no valuation, but it's cheap, so I do based on technicals. And finally, volatility, it is low. It is the volatility index. It is low. It is cheap. Therefore, I think it's a high probability trade. Okay, so that's all for this evening. I will quickly load up the video so you can rewatch again. And the next thing is, please go back to this particular, this trap and ask me any questions you have. I'm so sorry. There's quite a lot of questions coming from all over the place. And I think I will focus a bit more on the Telegram, easier to answer. Ken? If you hit 16, it's okay. You will make money both ways. Okay, Ken? So help me go back to here, this particular portion. Write in the comments. Also tell me whether you all like more of this. Also share with me what you have learned. Okay, so go to the Telegram and then share your learnings. And I'll see you guys. Bye-bye.